To understand the scale of Indo-MIM at peak output, you must look at the automation required to operate the world's largest metal injection molding facility. The initial coverage has focused on the top-line numbers for this July 2026 IPO, an FY26 revenue of 4,193 crore rupees, with a profit after tax of 534 crore. The price band of 461 to 485 rupees, paired with the company's dominant global market share, serves as the baseline for the standard retail consensus. This consensus views Indo-MIM as a high-volume, asset-heavy manufacturer, one whose fortunes are primarily tied to the cyclical demands of global automotive supply chains. This perspective overlooks a shift within the business model. Moving past the headline metrics requires testing the durability of their margins and how their pricing multiple actually compares against domestic peers. Evaluating a 24,000 crore rupee market capitalization requires a dual-axis framework. We have to weigh their structural margin defense against the actual IPO multiple valuation. First, we need to determine if the company possesses durable competitive advantages as it expands into adjacent technologies. Second, we have to look outward and see how its financial profile holds up against its primary global competitors. Determining the correct valuation requires testing whether Indo-MIM is evolving away from its auto ancillary roots and into a precision engineering company. The competitive moat for Indo-MIM relies on a localized global footprint. They operate 15 specific facilities distributed across India, the US, the UK, and Mexico. A critical component of this network is the presence of ITAR-compliant capacity located within the United States. This US-based compliance positions Indo-MIM to secure Western defense contracts that are effectively closed off to their Chinese competitors. Once a component is qualified on an aerospace or medical platform, replacing the supplier involves intense regulatory friction, creating significant switching costs for the buyer. To expand this moat, the company is moving into next-generation segments like ceramic injection molding and 3D additive manufacturing, mastering over 80 advanced alloys. These technological capabilities allow them to capture high-margin, low-volume custom manufacturing without disrupting the output of their high-volume automated lines. Top-line growth is currently driven by cross-sectoral demand, the complex geometries required for EV powertrains, elevated global defense budgets, and an increased need for precision medical devices tied to an aging demographic. Their recent acquisition of PDV MedTech was specifically targeted to strengthen this healthcare division and capture that medical device demand. On the other side of the ledger, automotive components still command roughly 25% of their total revenue. This massive exposure leaves the company incredibly vulnerable to the frequent cyclical downturns inherent in the global automotive industry. Additionally, because the business historically exports between 77% and 90% of its output, it carries notable currency volatility risk. Finally, operating an asset-heavy manufacturing model brings high fixed-cost operating leverage. While the tailwinds provide top-line growth, that fixed cost leverage means any macroeconomic contraction will disproportionately impact bottom-line profitability. To verify the strength of Indo-MIM's moat, we have to look at the global landscape. The broader high-volume metal injection molding industry is highly fragmented and largely dominated by Chinese manufacturers. This table compares Indo-MIM against its primary listed global peer, Shenzhen-listed Jiangsu Gian Technology, which operates at a similar revenue scale of roughly 3,500 crore rupees. Looking at the profit after tax margin, Jiangsu Gian suffers from volatile net margins near 0.6%. That weak profitability is a direct result of their severe exposure to the highly competitive consumer electronics market. Indo-MIM operates with an EBITDA margin of approximately 25.5% and a return on equity of roughly 21%. Indo-MIM's deliberate pivot toward a balanced end market mix across defense, medical, and aerospace provides a resilient financial profile that its primary global peers lack. This pricing matrix provides the domestic context for the IPO. At the 485 rupee upper price band, Indo-MIM's post-issue market capitalization is approximately 24,000 crore rupees. At that valuation, Indo-MIM trades at 44.9 times its FY26 earnings. When compared against the Indian precision engineering peer median PE of 93.26, Indo-MIM is positioned at a significant relative discount. We can verify this discount at the operational level by looking at the price to operating profit multiple. Indo-MIM sits at 22.39 times against the peer median of 38.49. The price-to-operating profit metric strips out one-off tax or interest line items, proving that this discount is structural to the business operations themselves. Next, the operating profit-to-net profit ratio shows Indo-MIM at 2.01, compared to the peer median of 1.79. An OPNPR of 2.01 indicates a reliable, clean conversion of cash from daily operations directly into net profit. The market is currently pricing Indo-MIM as a global manufacturer, rather than assigning it the steep valuation premiums typically found in domestic defense and precision engineering pure plays. The future of this company hinges on its transition from volume manufacturing into the production of highly specialized aerospace-grade components. Indo-MIM offers a specific combination of its 6.8% global revenue share, resilient margins, and a quantifiable valuation discount. However, this valuation gap will only close if management successfully transitions the market's perception from an auto ancillary supplier to a specialized precision engineering firm. The long-term institutional investment case now rests on management's future operational execution, not just on their historical metrics. To monitor that execution post-IPO, institutional investors will use a three-pillar checklist over the coming quarters. First, the company must show a sustained product mix shift away from low-barrier segments and into highly regulated medical and aerospace verticals. Second, they must prove they can commercially scale their new additive manufacturing and ceramic divisions while maintaining profitability. Third, management must demonstrate highly disciplined capital allocation as they integrate recent acquisitions like PDV MedTech. If management executes effectively on these three fronts, the current 44.9 times multiple offers a defensive entry point for long-term horizons. If they falter and fail to diversify past their reliance on the automotive sector, the current multiple will contract. This is the clinical framework required to evaluate the Indo-MIM IPO.
If you like our video, please like, share, and subscribe.